So I would like to go in a little bit more detail what's going on in the real estate sector. So I think I can skip this, but just 2 or 3 words on that. You see that Germany outpaces the GDP growth compared to its peers, especially to France, Italy, Spain, and Netherlands, and even to the Eurozone. It's not that much as the UK in terms of GDP growth in 2013 and 14, but in the range of, let's say, potential growth rate above 1.5% per year, which will drive the labor market. And you can see there the unemployment rate on an ILO figure around 5%, and in the southern federal states of Germany, we have a skilled labor force, which, the unemployment rate is below 3%. So there's a fully employed economy in Bavaria or even in Baden-Württemberg. And one good thing, and this is more the result of the Agenda 2010, where we did a lot of labor market reforms and reforms in the social security systems, our nominal unit labor costs are only well below the peer compared to France and even Netherlands or Italy. And you see it between 2009 and between 2008 and 2014, all overall we have an increase of roughly 12% of the whole time. So it's a very comparative economy. Latest sentiment for the German economy is also quite well. You see a little bit of disturbance in the March figures, where IFO, the business expectation, were a little bit weaker than in March due to the fact that the Crimea crisis, as well as the crisis in the emerging markets, are impacting the German economy as an export-driven nation. So, but the upwards trend and the IFO assessment of current business sentiment is heading northeast. So it's overall a very the German economy holding its position. Our colleagues from the EMEA research team carried out a survey on the European investors' intentions. And you see from a German perspective, it's a little bit frustrating. Last year, Germany was on #1 position, and now it's only slightly ahead of Spain. So, it looks a bit ugly to me, to be honest. But at the end, when I presented a couple of minutes ago, I had the investment figures for the Q1 2014, you will see what happens. This is the overall investment volume in the commercial real estate sector of the top 10 markets in Europe. And you see 5 of the top 10 are German markets, including Düsseldorf, with more than 2 billion euros invested. All overall, we have roughly 17 billion euros invested in 2013. This is a share of the total investment volume in Germany of more than 50% in 2014. This changed a little bit in this year, so you can see what happens since 2002 and our forecast for 2014. In Q1, we have a total investment volume of nearly 10 billion euros only in the commercial sector. We see a lot of large-scale portfolios, not only core investments, but also value-add products in the market. Foreign investors are back due to the fact that we have a very strong yield spread between here. The orange line is the prime office yield for the top 5 markets in Germany. And you see it's not that much fluctuation around the 5% line, but compared to a 10-year bond, you have a spread of roughly 300 bips. And this is mainly one driver that investors around the globe are keen on German property. So this is interesting due to the fact that since 2007, after the Lehman crash, we have a large stake of domestic equity-strong investors looking for their home base. And you see in 2013, roughly 70% were domestic buyers, mainly German open-ended funds, special funds, insurance companies, pension funds as well, and a lot of private investors and private property firms. This changed a little bit in the first 3 months this year, due to the fact that we see a lot of Anglo-American investors who bought larger portfolios, as I said. spotlight on the residential transaction markets for portfolio sales with 100 units each in each transaction. We currently, in 2014, we have an additional 5.6 billion euros invested due to the fact that 3 larger transactions happened in the first 3 months, and our outlook for the residential multifamily housing sector is slightly below the 2013 figures, in the range of 10 up to 11 billion euros. The drivers in the office letting market, you see on the left-hand side, take up figures as well as a 10-year average, and it's around 2.4 million square meter on a cross basis. The forecast is slightly above the 10-year average. Sentiment picks up, especially in Munich, in Hamburg, in Frankfurt, as well as in Berlin. And the focus is, as always, on good product in inner city location, which is quite rare, especially in Munich, where rent in the prime end increased by 6%, and an additional 6% in Düsseldorf. All overall, we have an increase of the prime rent index of 1.5%. It's not that much, but the outlook is in the range of 2 up to 3%, Munich a little bit higher. So to sum up and give you a small outlook, and then we can go to our panel discussion. As Markus said, Germany is gearing up in terms of GDP growth, not in each part of Germany, but all overall. We see slightly more dynamics in the letting market, in the office sector, as well as in the logistics sector. The logistics sector was quite strong in the first 3 months this year. From an investment perspective, we have roughly 1.3 billion euros invested compared to 2.2 the whole last year. So there's more to come in the next 9 months. Germany is booming, and the confidence, especially from the national and international investors, is quite strong. But we discussed this before our event, that the availability of assets is key at the moment. There is a strong interest from non-European countries as well as from Asian investors, but their focus, especially from the Asian, is clearly to the top 5, top 7 markets. And as I said, there are slightly higher transaction volumes in 2013 compared to last year. A little bit below in the multifamily housing sector. So.